Why are you so relaxed about inflation not behaving like it should when you look at the correlation between U.S. employment and inflation?
So, a lot of what's going on, I think, in the inflation numbers is that we had this huge, huge recession. And, in some sense, it's a surprise that inflation didn't even go lower during the Great Recession. And the reason I think it didn't is because we did have very well anchored inflation expectations, and people understood that the Fed would do what it takes to bring inflation back to our goal. Here, I think we're in the same kind of situation in that we see that inflation expectations are fairly well anchored, and so I think that's also helping in terms of keeping inflation at our goal. I do believe that we're going to get back to 2% on a sustained basis over the next year or so, and I do think that we might see some variation in the numbers over time. It may go above 2% for a time, but that doesn't necessarily mean that we're in a shooting off period where inflation is going to take off. I don't see that happening. I think it's going to be a gradual process, and therefore the Fed can stay on our gradual upward path of interest rates and basically meet both parts of our mandate.
But so why does this labor environment not force wages up by itself?
So if you look at models and some Cleveland staff research actually does this, looks at sort of what are the indicators of wage growth. You can explain, it's not a mystery if you think about low productivity growth, which we've had over this expansion, 1% as opposed to the usual 2 to 2.5%, 2 and 3/4% in other expansions. The low inflation rate, and also conditions in the labor market. That explains the wage growth that we've seen. We've been hearing from a lot of our firms in our district that they are raising wages in order to attract workers. I think it's a matter of time that we'll see more of that feed through into the ECI measures of wages. We're already seeing that a little bit. I think that'll continue.